Welcome back to FUELSCast, a podcast by Mansfield Energy. I'm your host, Sydney Casey. Today we're jumping into a market update and fixed pricing discussion with special guest Andy Milton, Senior Vice President of Supply and Distribution at Mansfield, and Mac Cullens, our Director of Pricing. Andy, tell us a little bit about yourself, how you got started at Mansfield, and a little bit about what you've done here at Mansfield.
All right. So I had the great idea in college to get a sports management degree, putting that to good use today. But I did quickly learn that was not what I wanted to do ultimately, and found my way to Racetrack Petroleum in Atlanta. Got a great opportunity as a young 20-something to start there, doing everything from truck dispatch to supply optimization to all the basic stuff, and ultimately got a chance to trade products, trade gasoline in the Southeast. And then in 2005, 3 weeks before Katrina, I left Racetrack, came to Mansfield. Katrina hit, completely learned everyone's names through very challenging times. But now I've been here 19 years. And so I've seen a lot of storms, a lot of issues, a lot of fun challenges, and really enjoyed every step of the way.
Nice. We also have Mac Cullens in the studio with us today. He is the head of our pricing department here at Mansfield. Mac, same thing. Tell us a little bit about yourself, how you got started at Mansfield,
Sure.
and some good things you've done here.
Well, I don't know about those, but I've done things, whether they're good or not, is subject to others' opinions. I'm a Georgia native. I graduated from the University of Georgia. You know, I got the feedback that I'd worked on government RFPs before that was on my resume was the reason they called me back. And I came up here and they let me time it with a Georgia home game the Friday before and my interview.
You were bound for logistics.
Well, it was a happy accident, let's just say. And so I spent about 3 or 4 years on our pricing desk. It was essentially all government at that time. We weren't doing C&I like we do today. And then I was approached to come and run our environmental compliance team, which is now like spills and that kind of environmental compliance. It's like the LCFS programs and the RFS programs and our compliance with those programs. And I did that for about 3 years. And at that time, we actually owned an ethanol marketing company called CNN Ethanol that we ended up selling at one point. And, it didn't really make sense to have a full department at that point to handle RINs when 90%, 95% of our RIN transmissions went away. And he's signaling me to hurry up. Yes. Yeah. Do you want to? All right.
No, keep going.
Okay.
No, this is good.
Yeah, great. Fine. Anyways, I did that. We ran the risk team for a couple of years and then had the opportunity to come back and head up the deal desk, which is where I am today. And kind of was my first place here at Mansfield. And I'm honored to be able to head it up these days. And I really enjoy it.
All right. I'm going to set the stage. It's December 2024. We're looking ahead to 2025. Businesses are planning their budgets for next year, trying to price forecast what their fuel spend might look like. We just came off the busiest Thanksgiving travel season since COVID. Retail diesel prices are down almost $1 from what they were this time last year. And forecasts are showing that we're going to be in a supply oversupply for 2025. What are your thoughts on those market factors as we head into 2025?
We're certainly at a very low diesel price compared to what it has been the last, couple of years. I would say sometimes though low prices might actually be the cure for low prices. So we may see higher prices potentially going into next year because that lower energy cost has helped maybe grow the economy. Jobs report just came out very healthy. We'll see what the Feds decide to do later in December. All those factors may lead into a little bit of a growth for next year.
Talk to us a little bit about, you just started a new thing on LinkedIn, your top of mind, top 5, I think is what you called it.
Yes.
Walk us through what those top 5 top of mind are. All of them may not be related to fuel markets necessarily, but what were your top 5?
Yeah, and they all relate it to some degree, maybe about demand or about supply. A couple things. One, I think people are all hung up over China and fuel demand. I think they have basically kind of already set the stage for themselves. And yes, there may be more stimulus coming, and they're going to try to do everything they can to get fuel demand ramped back up. But population is going to ultimately be the real challenge there. And China now has 2 years in a row of decreased population year over year, and the numbers aren't small. And so ultimately, that's going to be a big factor, I think, with impacting global demand. And then looking at the other items, certainly the change in the political landscape, that's a major shift, I would say, going from a pretty strong regulatory group to maybe a group that's going to be a lot less regulatory focused and more business minded. So I would say that has a big change maybe in renewables, probably bullish for renewable cost, not probably for the use of biofuels, I would say. A couple of the things on that list included AI, and while that's not the factor this year, I would say going forward, every year going forward, AI is going to have an impact on demand, particularly when it comes to the job market. And I don't think this is a situation where in the past, an advancement in technology just created another market for jobs. I think this actually is a job killer, potentially long term. So I have to see how that ultimately plays out. That's not an impact for 2025, but certainly years down the road. And then you're going to force me to think about what all top 5 items those were.
I think OPEC was one. OPEC and
Yes.
Iran was one for you.
Yes.
Geopolitics today. It seems like there's several theaters right now where there's just a lot of chaos and a lot of opportunity for escalation.
Yes. And though I would argue the European situation is probably going to be not a non-issue, but less of an issue in 25. I think the Ukrainian president realizes Trump is not going to be as supportive financially and may concede territory to Russia that he was not willing to do 6 months ago.
Sure.
And I think that actually might lead to a calmer situation potentially in Europe. Middle East, whole nother issue though. South Pacific, whole nother issue as well.
Right.
So OPEC actually just announced they pushed back their output rises until April.
Yes.
So what is that going to look like for the market?
You want that one first?
Why don't you go ahead?
All right. I think OPEC will change their strategy at some point in time. I think they are basically just punting at this point and continue to punt, partly because we just talked about the China demand question. There's also, I think, a big concern they have of just market share long-term with the U.S. market. I don't think what the new U.S. Energy Secretary may try to push of just more U.S. production. I just don't know if that's really feasible to do 3 more million barrels a day. But I do think the Saudis are not okay, particularly in the OPEC Plus group. The Saudis are not okay losing market share to their own participants. And I think that's going to be something they will eventually probably change the strategy on. And then you also got to think of the Iranian situation where the Iranian sanctions have been kind of looked the other way in the current administration. The new administration will not do that. And I'd expect us to go back to probably close to zero Iranian production at some point later in 25 or 26.
Do you foresee any of the Russian refinery issues playing into U.S.?
It may be less of an issue if things calm down in Europe.
Yeah.
Andy, what are your thoughts if there is a push for increased domestic production of crude, even if it's a modest one, kind of swinging the supply here? We're already pretty much tapped out on refinery utilization here nationally. So, where does that crude go? And is it more of an export at that point versus being used for domestic production?
Yeah, probably more of an export. And you're certainly seeing, as a country, we're exporting more diesel, more crude than we ever have. Granted, it's not maybe the right spec that we need here. It can be the most optimal here. So get the light sweet out, bring in a heavy sour. But yeah, I think any additional capacity we have is going to be exported. Now, what's interesting, just recently Chevron announced they're going to have a less investment in the Permian. I think it was up to 10% reduction in their investment. Not to say that there's going to be less production. They're just less investment now that might impact production down the road. So that'll be really interesting to see coming as we enter the end of this particular decade. What is the U.S. production? Is it much less due to that lower investment level?
Yeah. Do you think that there's anything realistically that the new administration could do in order to incentivize additional investment and, domestic infrastructure from a refining standpoint? It seems like that would be hard because the return on those kinds of investments are not measured really in years, more in decades, I feel like.
Yeah. Yeah, I don't know. Certainly in the Permian, you may be tapped out just due to the ability to get the product from the inland out to the ocean as far as be able to be exported. So you might have to be more free with like permitting, particularly offshore. Maybe open up some regulations in places like Alaska where that's been kind of closed off. I can see that being something. And then you've got the whole trade tariff, which is the other one on my top 5 list, which I finally remembered there. Trade tariff's big wild card. Immediately out of the gate, Trump has made an announcement of what that would be percentage-wise, but sometimes there's talk and then there's action. Sure. We'll see what the action actually ends up being. And there's going to be some give and takes with these countries like Canada and Mexico, as we may want to actually also take our crude to Mexico potentially, but still want to take in Canadian crude as well for the Chicago refinery. So a lot of wild cards still to be figured out. All that is going to be just guessed on until we get into the administration sometime in 25.
Do you foresee, though, the drill baby drill kind of playing out, or do you see it kind of?
It's certainly overall his administration is going to be more pro-business and less regulation. But I think what people are realizing, too, there's only so much the U.S. can produce. Going back to your question. I do think probably a bigger factor is the fact you've had all this consolidation by the producers. They're much more efficient with their operations. They're also more conservative with their spend as opposed to the wildcatter mentality. And I think that probably actually limits any kind of crazy growth patterns in U.S. production.
I also think going back to your, some of the best cure for low prices is low prices. You ramp it up and you flood the market, and all of a sudden, it's not profitable for a lot of these organizations to keep doing it. It kind of keeps it in regulation or regulated. It also works the other way around. The cure for high prices a lot of times is high prices too. So,
which we had for several years, very high energy prices, and it caused all kind of challenges. We had inflation, we had some economic concerns. Certainly, the economy feels better right now, having some rate cuts. People feel a little more comfortable. Again, job market, this recent job report was fantastic, very positive. So I'll have to see what ultimately happens.
Back to one of your top 5 was the biofuels kind of renewable piece being a wild card, I think is what you called it. Talk a little bit more about that and what we might see. Do you think legislation might slow down under the Trump administration, or do you foresee that it might hold strong, but just a little bit slower?
Yeah, the hard truth is many of the biofuels that are in the marketplace wouldn't exist without federal and, in many cases, state incentives. So if you take away some of those incentives, you're going to have less of that production. And we're already hearing, biodiesel over the years has already been reduced several times with many closures. We're already hearing a lot less production on tap right now for early 2025, just given the uncertainty and the potential change in regulations. Because right now there's no dollar tax credit for next year. There's a 45Z producer's credit, but that's not $1 anymore. That's going to be some percentage of $1.
What's your take on all the biofuel piece from a pricing standpoint?
Well, it's to Andy's point, it's really kind of hard to predict the future. I do think that in certain markets, there are enough programs in place that there's going to be some kind of counterbalancing in the way that these programs interact with each other. So if you take a market like California, and you look at the programs that support pricing in California, well, you've got the blender's tax credit, which is going away and turning into a producer's tax credit, which, while it may not be the full dollar, is still going to subsidize that volume at some level. You've got the renewable fuel standard, which has what we call RINs associated with it, which something the refiners need in order to produce their fuels, traditional hydrocarbons. And then in California, also, you have a low carbon fuel standard and a cap and trade program. And so where you may see, and also a mandate on a lot of the dyed fuel there in California. Also, our customers up in Minnesota, the fuel today is mandated to be blended with a certain amount of biodiesel. So that's going to at least prop up some domestic usage. But if you've got all those different programs and all of those programs, outside of the blender's tax credit, but you've got the RFS and you've got the LCFS and you've got the cap and trade program, those are all free market programs, which means that the price for the compliance with those programs is set by the market. So if you may see something where the producer's tax credit is much lower than the blender's tax credit, but then your LCFS credits in the states that have LCFS programs, they may rise. You may see where RIN prices go up because at the end of the day, there will likely be some kind of renewable volume obligation for the fuel refiners where they need those RINs. And so if there's less discretionary blending, meaning people that are blending just because they want to, that means there's less RINs in the market, which may cause the price to go up there, and they may kind of all just kind of offset each other. It's very chaotic. It's going to be interesting to watch. I think it is going to be devastating to markets that where there's not a lot of programs out there besides the traditional RIN program and the blender's tax credit.
If they don't have a state program.
If there's not a state program or anything that's supporting it, or even in maybe even other markets, potentially like even Texas, where there's a sales tax credit, it may not be enough to offset it and make it make sense for folks.
Yeah, and you think about the last time the Trump administration was in place, you had I think a lot of SREs, so small refinery exemptions, where they didn't have to go cover their RVO. I could anticipate maybe a lower RVO in general. RVO. So to your point, there's a lot of different moving factors that are going to make it chaotic.
Yeah.
I could definitely see a lower RVO and the small refinery exemptions. I don't think that they could. I'm interested in your take on this. I don't think that they could just pull the plug on the RFS.
Yeah, I don't see that. I'm with you on that. But I could see it maybe being flattened out.
Or given a sunset date or something like that,
maybe.
Potentially. I think that the infrastructure with the RINs and the RVOs and with the biofuels is so critical now that I don't think that that's something you could just kind of kill mid-flight.
No, but also the farm industry, I would say, wants some regulations as well. So you don't want to lose that vote either.
Yeah. Let's switch gears a little bit back to a topic, days of supply. That's something we talk about almost every market update we do. I think we've defined it. Most people know what it is by now. What's that looking like right now compared to previous years, and how's that going to power for stability in 2025?
Yeah, and specifically diesel days of supply.
Yes, diesel days of supply.
Basically, it just takes into account what the supply levels are and then what the demand rate is at that point in time, just to give us some perspective and kind of what the balance is. It had been just recently under 30 days for like 6 weeks in a row, which is kind of the interesting watermark about you tend to have some supply issues when it stays under 30 days. Above 30 days, it tends to be very decently supplied. You don't have those issues. Last December and into January, we gained 13 days of supply of distillate just on the back of higher production and lower demand. Good quality production levels right now, so I could see that maybe growing. I don't know if the demand is as soft as last year. We may see demand help a little bit, but I would still expect diesel supply to improve over the holiday season, barring any kind of crazy weather event.
Yeah. How does that play into pricing for customers, or does it really?
It does, but it's really kind of it's kind of indirect, right? You can't like necessarily just map out days of supply and then map out fuel program or fuel prices and see, a very strong correlation. The days of supply really impacts pricing in a more general sense, in my opinion, kind of in local markets in particular. So as days of supply, especially days of supply, being low is going to drive prices up. But particularly in markets that, maybe at the end of a pipeline or maybe rail fed or not as, liquid as far as, transportation there. Denver's another good example of a market that has, some constraints around its supply. If the days of supply get short there or long, we've seen it go both ways. You could see incredible volatility in those markets because, it's not like, the diesel's coming every day on the pipeline. They've got to wait for the next cycle to come through. And sometimes those, especially those less liquid markets, some of the end of the pipeline markets, some of the rail fed markets, they get extremely short or they just run out and they'll pop 40 cents relative to some of the other markets that are kind of in their general area over the course of a couple of days. And we saw a lot of that in 2022, kind of in the Baltimore area and Denver area.
East Coast. And I would say, too, your point earlier about refinery utilization, if anything, the U.S. may have a lot less refinery production in the next few years.
Sure.
You're going to have Lyondell officially shutting in Houston. They've already begun that process there, which offsets the Exxon gain in Beaumont earlier in the year. Then we've got Phillips that already made the announcement in L.A. They're going to close that facility in California. California already has very high prices. That's not going to help that situation any. We may see a few more smaller ones, more of those niche markets that may have some refineries closed, which, to your point, that local market might get kind of crazy.
Curious your thought about this. We've actually seen some of the refineries, change their production from traditional hydrocarbon diesel to renewable diesel.
Yeah.
And, if there's, a lot of these, if it comes to pass, a lot of these incentives that subsidize those renewable fuels go away, do those refineries just get shuttered, or is there a possibility they get turned back into fossil fuel, regular diesel production?
It's a great question. I got to think, though, most of those conversions, the full conversions, have been in California. So to your point about, I don't see California changing its local regs, so I'm not worried about that. But we have had some in, Louisiana that have converted over or been created or carved off so that they can have maybe some co-producing going on. I think that's going to ebb and flow with just what the economics say. Now, what's interesting, we didn't mention this earlier about biofuels, you're seeing a lot of this conversion of these facilities to SAF, so away from renewable diesel and into the SAF market. And some of the SAF prices, you're talking about guaranteeing $7 a gallon, which I think is just bonkers. I think as a consumer, I've never looked at my flight and said, gosh, I really want SAF as opposed to jet fuel on this flight, and I'm willing to pay a higher ticket price for it. So I'm curious how if that sticks long term, but that definitely impacted the RD supply when you've got stuff being carved out and going over to SAF.
Yeah.
What will warrant for the U.S. to build a new refinery if all the ones are going to shut down? Or is that never going to be a possibility?
I will bet you money right now that will not happen. The last of refinery of any size of consequence was built in 1976. I think it was the Garyville facility, 75, 76 was built. And otherwise, you've had some small facilities that have come on, but not of any kind of consequence and size.
But you could see some retrofitting, updating of equipment.
Absolutely.
And that's kind of where I was going earlier with my question about the development of, infrastructure here in the United States for production and refining. Even if it's not like building a refinery from the ground up, if it's, replacing equipment or retrofitting.
One in Bakersfield, I think it's actually opening up in the next few weeks.
Incredible.
And that's been closed for years.
Incredibly expensive. And the return on that investment is very long in order to, recoup the costs associated with So
Absolutely.
that's a kind of where I was curious, is there something that the new administration may go and do to give those producers confidence that, okay, yes, I've got some lead time here with support that, I don't feel like I'm going to sink, tens of billions of dollars into this.
Well, you certainly see an increased amount of, I would say, government funding going into a lot of facilities lately, last few years. So I think that certainly has helped. What will happen going forward? Likely that government funding, I would assume, will dry up in January with the new spending concepts. So I'll have to kind of see how that plays out.
We'll see.
Yeah. I think right now they're trying to push out as much money as they can before all that change comes.
So how many shutdowns or such before we should worry, I guess?
Well, it just for clarity on what's, no pun intended, driving that, but gasoline demand peaked in 2019. I've been very vocal that I think that was the peak in the U.S. We will certainly continue to export gasoline and export diesel when we have any spare capacity, but I think that will drive the economics, and the economics will drive the decision by the refiners. No one wants to run an unprofitable business. And when you've got a 100-year-old or an 80-year-old asset that needs constant investment and it's not cheap, you're talking billions of dollars of investment, at some point it just doesn't make sense to continue doing that. I mean, that's an example with Lyondell. I think it was over $1 billion to invest to keep that refinery operating with today's standards. Didn't make sense to keep it going at today's economics. So as demand continues to go lower, I would expect that production to continue to decline in the U.S.
Yeah, if you get a $150 crude, though, can they get that thing back up and running relatively quickly?
Well, it doesn't matter about the crude price. It's about the crack spread.
Sure.
Right? So if the market warrants, and we actually saw it post-COVID, actually saw a couple more maybe live longer as an operating facility than maybe we anticipated. You had some distillation units that were maybe mothballed, come back open. But again, when you have lower economics, one thing at $40 crack spreads, sub 20, they're not going to be as excited about that.
Got it.
One thing not on your top 5, top of mind.
Well, it didn't make the top 5 then.
It did
Maybe
make the top
6,
5.
7.
Well, okay. What number are storms for you in your top of mind?
Probably not even the top 10 because I can't
Not
control it.
even. Yeah.
So we had 2 pretty major hurricanes this year that impacted Florida and the Southeast. That's going to happen. Not a lot we can do about that. I think the winter storms are certainly concerning. Knock on wood, we never have a winter storm Uri again like we did in 21. But those kind of things, those major weather events are things that could absolutely occur, but you never know when and where they're going to occur.
Yeah.
That gets to be a challenge because we just have zero control over it.
I think that's actually one of the things that really sets us apart in the industry is, those things are going to happen. You don't know when they're going to happen. You don't know where they're going to happen and to what extent, it's going to cause damage or interruptions.
Sure.
The ability that we've got here at Mansfield with all of our supply points across the United States, our carrier network, it's not uncommon for us to long haul fuel in from Chicago down into the Southeast if there's a major storm that's impacting.
Think about the one we just had. Was it Helene that went through the Carolinas? I mean,
Sure.
I can imagine that market is going to take years to fully recover from a logistics, road, transportation, bridge situation because no one in that area had seen anything like that before.
Right.
Where Florida, in a few weeks after a hurricane, as long as there's no major disruption, kind of back to normal from a supply standpoint and all the logistics.
Sure.
But I think we had out-of-town trucks in North Carolina for weeks and weeks and weeks.
Right.
Any other wild cards you see for 2025?
Yes, but we do have the bingo card coming up, which I'll be
yes.
posting on in a few days. I'll have some really wild cards on that one. But, I think certainly what we can control here in the U.S. is going to be really fascinating. I don't know that we could come from a one stance on politics to a completely different other stance on politics. And it really seems like a lot of the people that come in the cabinet are more business and less political. So it'll be really interesting to see how that plays out. SEC chair, very pro-crypto as an example, just talk about the differences and where things have been versus where they are. We won't get into crypto today. That's all separate.
I know Mac is
FUELScast.
so disappointed. We're not
He was
going to get
excited.
into crypto.
I'm excited to talk about it anytime you want to talk about it.
That's great.
But, but I do think the impacts on things like E15 would be another example. There's some federal regulations there that I would anticipate might change the demand and how that looks for consumers. Biofuels probably being the still biggest wild card. That's why it did make the top 5 as far as that goes. Middle East didn't make the top 5 on my top 5 list, but I would say that has something to continue to bubble up. For the unfortunate events in the Gaza area.
Is that your number 6?
Well, when you think about how the U.S. has essentially backed out of the Middle East, where it was a number 1 place for us for decades and decades and decades, quite honestly because of crude. Well, now we're the largest crude producer in the world, so we don't need that area anymore like we used to. And it changes how we deal with those countries. So it's a really fascinating situation there. So with the U.S. out of the Middle East more and more, how those countries interact will be really interesting.
Yeah, I think those are all really good points, and we're going to talk here a little bit later about risk mitigation and some of the things we could do there. But I don't know how helpful it is to talk about, but to me it's always something that I try to keep in mind is kind of the unknown that is always kind of floating out there. These are a lot of known unknowns, things that we know are kind of on the horizon, but it could happen. And we're able to forecast. We think this will happen, or X will happen, or Y will happen, and it'll have this kind of impact. A lot of times when I talk to folks, I bring up something that was called IMO 2020.
I remember that.
And what IMO 2020 was it was a regulation that went into effect at the beginning of 2020 that basically changed the spec of fuel that ships would have to burn when they were out at sea or in U.S. waters, from something that was different than kind of the heavier distillate bunker fuels that they've been using to something that was much closer to just ultra low sulfur diesel that like we use on the roads here in the United States. And so when you're refining crude, you can't like just 100% make gasoline or just make 100% make diesel. You've got to make really, you can kind of tweak those ratios,
A whole slate of
but
products there,
you've got to make all of it, right? You're going to end up with some really light stuff and some really heavy stuff. And so this was going to displace a lot of gallons that were traditionally kind of the heavier gallons and more into the medium area where you've got the ultra low sulfur diesel. And so everybody was saying, okay, this is just going to make diesel prices go up. There's no way that we can have all this increased demand with the ships and our U.S. demand just over the road and off the road and construction, and it's just skyrocket. Fuel prices are going to skyrocket, especially diesel. This regulation is going to be just catastrophic. Well, the unknown was like right about that same time. There was a disease that was starting to spread around the world, and whereas 5 months before it, a lot of people were projecting $5 diesel or just really expensive products. We had crude trading negative on the NYMEX.
April 20th, 2020.
Yes, it was a big day. So it's that's just one of those things that I try to keep in the back of my head and think about is we've kind of got this range, and your risk tolerance may say, okay, well, I can live within this range, but also what if something happens that makes fuel prices go down to 50 cents a gallon, or makes fuel prices go up to $7 a gallon?
Like the war between Ukraine and Russia. Right?
We had
$5 diesel.
Yeah, we had, there were 50, 60, 70 cent up days. We had a $1 down day.
I often go back to 2020 and 2024, that time frame, and think, what in the world?
Yes.
That was some crazy, crazy event. So your point being, all the different wild cards that may or may not happen, from a risk mitigation standpoint, consider that with your program.
Yep. And just, and also it's kind of the stress test for it, right? So, it's saying, okay, well, can you may feel comfortable that, diesel prices are going to be between $2 and $3 a gallon, and say, okay, well, I can live within that range. But is it catastrophic for your business if diesel goes to $5 a gallon? Or is it catastrophic for your business if diesel goes to 50 cents a gallon?
Yeah.
So just that unknown is just something to kind of think about.
We'll talk more about that in a minute. Before we do, we said that this podcast episode, we were going to do a price forecast for
Mac was going
2025.
to do a price forecast.
Yeah, you said you were too. So you may have stepped in it right there. But for perspective, today's diesel average across the U.S. is $3.48 a gallon.
Okay.
Retail. What's your price forecast? Well, let's go back. WTI right now is also about $67 a barrel.
Yep.
What's your price forecast for 2025?
For crude?
Yeah.
I think we could go a little lower. I think we could go a little higher. So, yes, I could see. Shocking. I could see.
We'll do the prices right. What's your best guess without going over?
I know, right? I could see lower, low 60s, just based on demand concerns globally. But I could also see us get back in the 70s on crude because the economy does rebound later this year. Some advancements in the Middle East get a little bit crazier when it comes to a conflict. So I could probably see a range, maybe low 60s to mid to upper 70s.
Okay, so he's given a range of 65 to 70. Mac, what's your best guess?
Well, I'm actually probably, I'd say I'm moderately bullish. I just think we talked about the geopolitics earlier. There's just so much going on right now, between Russia and Ukraine and what's going on in the Middle East. Even recently, there's chaos in South Korea. What's going to go on
bizarre recently, yeah.
with, China, Taiwan, North Korea.
Sure.
I see some fundamentals that may say, okay, we may be, directionally, just if you look at it from a pure supply demand standpoint, kind of flat to maybe going down slightly. But I think any of those kind of wild cards from a geopolitical standpoint just has the ability, even if one of them to erupt, just to pop. And you see, I don't know if you see 2022 all over again, but you could see a muted version of that. And, if it's bad enough, you could see another 2022 all over.
Well, and to support your point, global inventories are at very low levels from a crude and product standpoint globally. So the only reason that prices aren't very high is because of lower demand.
Right.
So if you did get a demand kind of growth coming out of a new administration, more business friendly, less regulation, low prices for a while may help spur that, and that may be the case from a price standpoint.
All right, we'll jump back into the.
So do I need to give you a number?
Oh, we gotta have a number.
We'll look back on it and see what's right. I'll go 75.
That's the average.
75.
Okay. All right, I'll take the under.
Okay, so 65 to 70, and then Max going 75.
Yeah.
All right.
12 months from now, you're going to do another FUELSCast.
We'll do a follow-up.
Deal.
The price is right. Back into the fixed price conversation. So Mac is the head of our pricing department here at Mansfield. We'll get into your background here in a little while.
Okay.
Talk to us about fixed price programs and what that might look like, how to get into a fixed price, what goes into deciding whether or not they want to lock in a fixed price. Kind of define it for
Yeah,
us.
sure. So when we're talking about a fixed price program, first and foremost, it's really a risk management program, and we do those for our customers, and usually it's a program that we put together in conjunction with a customer's purchasing department, procurement department, their budgeting, their finance department, and it's really to kind of the point there is to go ahead and set a price for fuel that you're going to buy in the future for a certain amount of time, for a certain amount of gallons, so that you can just kind of take that risk off the board. And you can know that, hey, for 80% of my fuel spend, I know I'm going to be paying X dollars per gallon, and go ahead and know that, if fuel goes down to, or fuel goes up, from $3 a gallon to $5 a gallon, it's not going to crush your budget. And you're also giving up some downside potentially that, if fuel goes from $3 a gallon down to $2 a gallon, you're not necessarily participating it under a traditional fixed price program. But a lot of the times, we're working with folks that are very concerned about just removing that risk from the budget and just going and securing it so that, they may not participate if the fuel market happens to go down. They're not going to get crushed if fuel markets go up. And, if you look at the things, that impact fuel prices, when we're talking about our customers, and even Mansfield itself, you're talking about, geopolitics, domestic production, regulations, weather, speculators in the market, right? The speculators have a huge impact on what's going to go up or what's going to go down. And, it's a wide berth of kind of things that are impacting pricing in kind of a chaotic way. But there's one unifying thing that they all have in common is that our customers in Mansfield have no control over any of them. So you're really kind of at the whims of the market. So if you're somebody that is, if fuel prices are going to impact your bottom line or impact your budget or impact your ability to do business, it's worth taking a look at some kind of price risk management program and saying, okay, is there something out there that works for me and my unique needs and my unique risk profile?
Yeah. And kind of what we were just talking about with all the price forecast, diesel futures are low twos.
Sure.
Yeah, that's a great time. And it's pretty forward out, kind of a flat. It's not very backwardated. It's not a contango. I was advising customers, I would be really looking at that 26, 27 time frame. To your point, the unknowns.
There's
Who
a lot of
knows what's going to happen 2 years from now. Take that risk off the table.
I mean, we spent the first 15 minutes talking about what's going to happen in January, right? What's going to happen in 2026? What's going to happen in 2027?
Great point.
Who knows? It could be completely different.
Yeah.
And so, we have a lot of our customers that are going out, into further years, especially where they have contracts with their customers or projects that they're committed to at a certain value. And they're just saying, and to your point, we're low twos or in the teens there. It was a couple of days ago when I looked, so it's probably better now, but it's relatively up to date. We were the prompt front month heating oil futures were about 30 cents lower than the average for just calendar year 24.
Yeah.
24 has not been, at least since going back to 2022, one of the higher price years. If you go back to, the entire average going back to the invasion of Ukraine, it's something like 70 to 80 cents lower than the average price over that time frame. So we're in an era of pretty low prices right now. And, and I don't speculate, and we don't speculate as a company, but sometimes, it's worth discussing whether or not there's asymmetrical risk.
Yeah, I was going to say it's the risk versus reward.
Right.
Worst case of COVID, diesel, and that was a really bad situation.
I mean, the world shut down.
I think we got down to maybe 30 or 40 cents.
And that was for like a month.
And it was a blip, and it was the worst event ever. So maybe your worst case from here, you're down $1 maybe, but your upside could be probably more than $1. To your point about the asymmetrical,
right? And that's kind of, I feel like for folks that are, ideally we'd like to try to do it on tie it to a budget and not necessarily speculate the market, but there's folks that have different risk profiles that can take some price volatility, but not a lot of it. And so, or they may have, a portion of their customers that they're exposed fuel prices to, and a portion that they're not. And they may have to make some educated guesses there as to what their portfolio of business looks like going forward. And that's where some, discussion may lie where strategically where you say, well, the likelihood that we're, sub-dollar diesel for any extended period of time, barring the unknown unknowns that we talked about, I feel like is a very low probability of that. The probability that we are, for an extended period of time over $3 a gallon on heat futures, that's not a super low probability event in my mind. There's a lot of things that could lead to that and could lead to that pretty quickly.
Do we have an ideal customer for a fixed price program, or is it really all just based off their risk profile, their needs?
Well, it's as far as ideal, it's really anybody that, again, like we talked about earlier, is that if the price of fuel is going to potentially make your business exponentially more profitable or exponentially less profitable or unprofitable or not feasible at all, then, that's something where you probably just want to at least take some of that risk off the table. And, we have so many different customers and the risk profile for all of them is unique. There's very few kind of standard templates to how we talk to our customers about a fixed forward program. It's really there is a little bit of discovery to figure out, okay, what's your exposure, how long is your exposure, what kind of tolerance levels do you have. So there's some general guidelines that we have, but really everything that we design for our customers is going to be tailored to their specific needs. But from a general perspective, if the price of fuel is hitting your bottom line and you can't control that, then you need to talk to your fuel supplier about getting some kind of risk management program in place, in my opinion.
Right. Now, obviously, there's some type of commitment there from the customer standpoint, whether it's like a volume commitment. Mm-hmm. What if they don't meet that volume commitment? What happens?
That's a really good question, and that's something that that it comes up as a question a lot of the times especially when folks are new to hedging or new to a fixed forward program. There is a commitment that's involved with the fixed forward agreements. We can structure those agreements to, have different amounts of flexibility in them. But there's also, provisions in our terms and conditions to address shortfalls or overages and things of that nature. And it's very fair in the way that it's done, where we may be able to move gallons from one location to another or extend a contract out. We were talking earlier about 2020, and we do have a large portfolio of fixed priced or fixed forward customers, very geographically dispersed in a lot of different verticals. When the diesel was trading at 30 or 40 cents a gallon, and crude was trading negative in April back then, well, part of that was a storage issue, but part of that also was just demand cratered. And our customers that we have been working with and under these programs for 10 years or longer in some cases, look, they didn't have the demand either.
And it wasn't anything that they did.
Yeah.
Right. It was beyond their control.
Right. So even I don't want to get into specific companies or anything like that, but you could talk about government agencies in general. Sure. And like transit authorities. The buses were running less schedules because nobody was commuting to work. And a lot of, municipalities were shutting down and doing work from home. And, there's, just overall decreased demand. And our customers saw that, and our customers' customers saw that, and it impacted them. And so, that's something that we really had to work with in 2020 with our customers to work out an arrangement where we could help them defer that obligation or restructure that obligation. And, I'm very proud that across our entire portfolio of customers that we had at the time in 2020 under fixed price, we didn't have a single contract default with any one of them, because that's awesome. We rolled up our sleeves. We got in there. We said, okay, we get it. We're going to work in good faith with you guys. You guys work in good faith with us, and we'll figure out a solution. And so I don't want to, by any means, diminish the commitment part of it, because it is an important part of it. But I do want to say that, like, if the unforeseen happens, or if, just because of, a weather event or something like that, you're not able to hit your commitment for that month or whatever structure you're under. Look, at the end of the day, we value our customers and we value those relationships. It's not in our best interest, and it's not in the customer's best interest for us just to throw the book at them and say, write me a check and
contract
says this. Like, there's language in there, but we don't want to do that. We want to be the good guys. We want to help them out. And in my experience, and I've been doing this for quite a few years now, we've never really ever had a situation where we weren't able to work something out with one of our customers.
That's good. That's awesome. Well, Andy, Mac, thank you for sitting down with us today, enlightening us about market update and fixed price. If you're listening and want to know more about anything you heard today, their contact information will be in the bio, and you can reach out to them via email or pick up the phone and call us. If you liked what you heard today, leave us a review. Thanks for listening. Thank you again to Andy and Mac for joining us today to discuss what's ahead for 2025. Be sure to subscribe to our podcast on Spotify, Apple Podcasts, or YouTube so you never miss an episode. We would love to hear your feedback. Leave us a review and let us know how we're doing. If you have an idea for a future episode or want to ask a question to any of our guest speakers, email us at FUELSCast@mansfieldoil.com. Thanks for listening. Until next time, bigger reach, broader solutions, better advice. Now you can.